Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. So, Sandy, let's talk about the recent sharp increases in mortgage rates that Canadian homebuyers are facing. It's a pretty significant challenge right now, isn't it?
Absolutely, Steve. Mortgage interest rates in Canada are reaching new heights, the highest we've seen in over a decade. This is really intensifying concerns around housing affordability across the country.
That's right. The Bank of Canada's current outlook is indicating sustained high rates, and this is impacting both first-time buyers and those renewing their mortgages. It's a rapidly shifting financial landscape for many.
In October 2025, we've seen Canadian fixed mortgage rates shoot up significantly. Many financial institutions are reporting rates above 5%. This spike follows a series of rate hikes from the Bank of Canada aimed at curbing inflation.
These higher mortgage costs are definitely straining household budgets, especially for those trying to buy a home in an already competitive market. It's making prospective buyers more cautious because of the added costs.
Exactly, Steve. As these rates climb, affordability becomes a really critical issue, influencing buying decisions across the nation. It's a tough situation for many Canadians.
Looking at the Bank of Canada's rate outlook, it seems experts are forecasting a sustained period of high interest rates. Earlier projections suggested possible rate reductions, but those have been delayed.
The Bank of Canada aims to stabilize the economy by addressing inflation, but this strategy is having a heavy impact on mortgage holders. Current forecasts indicate little to no rate cuts in the near future, which means Canadian borrowers are left with very little relief.
For those renewing their mortgages, budgeting for higher monthly payments is now a necessity. It's a tough pill to swallow for many.
Indeed, Steve. And housing affordability in Canada continues to be a pressing issue as mortgage interest rates rise. High borrowing costs are adding to the existing pressure from property prices, which remain elevated in urban areas.
The affordability crisis is evident as more Canadians struggle to qualify for loans under stricter financial conditions. Investors and homebuyers must navigate this challenging environment, considering alternatives such as longer amortization periods or even smaller properties.
In conclusion, the rise in mortgage interest rates in Canada signals a profound shift in the housing market landscape. As rates reach their highest in over 10 years, the impact on both new and renewing mortgage holders is significant.
It's crucial for homebuyers to reassess their financing strategies while keeping a close watch on the Bank of Canada's policies. Adapting to these changes with a strategic financial plan is essential for navigating the current and future market conditions.
Let's shift gears to discuss the diverging forecasts from Canada's major banks regarding interest rates in 2026. Steve, what's the general sentiment among these financial institutions?
It's quite interesting, Sandy. After a year where rate cuts were largely anticipated, there's now a growing debate about how long this easing cycle will last. Some banks are even suggesting rates might start to climb again in 2026.
That's definitely a shift from the earlier focus on rate reductions. It seems like there's less consensus now about the long-term direction of interest rates.
Exactly. While most banks agree that modest rate cuts are still on the horizon for the end of 2025, the forecasts for 2026 are varied. For instance, RBC has taken a more dovish stance, expecting the rate to hold around 2.25% through 2026, which is lower than their previous estimates.
On the other hand, banks like Scotiabank and National Bank of Canada are anticipating higher rates. Scotiabank projects a return to 2.75% by late 2026, while National Bank expects a rise to 2.50%.
Right, and TD and CIBC are somewhere in the middle, both forecasting a rate of 2.25%. The tension between weak economic growth and high inflation is certainly influencing these projections.
It seems like inflation is playing a significant role in these forecasts. Scotiabank's economist, Jean-François Perrault, pointed out that inflation could remain more persistent than the Bank of Canada currently assumes, potentially reversing rate cuts in the second half of 2026.
That's a crucial point. Bond markets are also signaling a floor in long-term yields, suggesting that any rate relief along the Government of Canada curve might be modest. RBC economists have highlighted persistent inflation uncertainty as a constraint on how far yields can actually fall.
With these constraints, it looks like fixed mortgage rates could face upward pressure even as the Bank of Canada trims its policy rate. Oxford Economics expects fixed mortgage rates to remain elevated through 2026, which could be challenging for borrowers.
Borrowers with variable rates might see some relief, but fixed rates are forecasted to edge higher, with the 5-year conventional mortgage rate potentially reaching 5.2% by early 2026. It's a complex landscape for anyone navigating mortgage decisions right now.
Let's shift our focus to the latest figures on Canadian housing starts, Steve. It's been reported that housing starts have risen by 19% year over year in Canada's largest markets as of September. This is quite a significant development, isn't it?
Absolutely, Sandy. The Canada Mortgage and Housing Corporation's recent report highlights how cities like Montreal and Toronto are leading the charge, contributing more than 25% of the national starts. It's largely driven by increased rental apartment projects being launched.
That's right, Steve. The total starts have risen to 22,375 units in centers with populations of 10,000 or more. This marks a 5% year-over-year increase in the year-to-date total, reaching 178,033 units. It's a promising trend, but there are underlying concerns.
Exactly. While the numbers are encouraging, CMHC officials, like Tanya Barraza Ochoa, are cautious about a potential slowdown in residential construction. She points out that these current levels reflect decisions made when investor confidence was higher.
It's interesting to note that Montreal posted significant gains of 135% and 112% year over year, respectively. However, Vancouver, which is Canada's third largest market, saw a slight decline of 1%. This variation highlights the different dynamics at play in each market.
That's a good point, Sandy. The seasonally adjusted annual rate of housing starts nationwide also grew 14% month over month, reaching 279,234 units in July, compared to 244,543 in August. Meanwhile, the 6-month trend moved up 4.1% to 277,147 units.
These numbers show some resilience in the market, but as Tanya Barraza Ochoa mentioned, it's crucial to remain cautious. The decisions driving these starts were made in a different economic context, and the future might not mirror the past.
Exactly, Sandy. The housing market is certainly showing strength in terms of starts, but the broader economic conditions and investor sentiment will play significant roles moving forward. It's a dynamic situation that requires careful monitoring. Sandy, let's delve into the recent penalties imposed by Ontario's Financial Services Regulatory Authority on 2 former mortgage agents. This is a significant development in the mortgage sector, isn't it?
It really is, Steve. The FSRA has imposed a combined $230,000 in administrative penalties against Satyam Kumar Trivedi and Sasitharan Somasekaram Pillai. The reasons cited are quite serious, involving reckless conduct and failure to verify crucial information, which led to a substantial investor loss of $624,000.
That's a hefty sum. According to the FSRA's order, both agents allowed themselves to facilitate dishonest activities, including fraud and illegal conduct. They also operated outside their licensed brokerages, which is a clear violation of Ontario's Mortgage Brokerages, Lenders and Administrators Act 2006.
Trivedi, whose license expired in March 2024, settled with the FSRA and was ordered to pay $180,000 in penalties, Meanwhile, Somasekaram Pillai, who did not contest the regulator's proposal, was penalized $50,000 after his renewal was refused. It's a reminder of the importance of adhering to regulatory standards.
The case originated from a 2023 complaint by an investor who was approached with a mortgage investment linked to a gas station property. Trivedi, acting as the investor's agent, failed to verify key documents, including an appraisal and borrower identification, which turned out to be falsified.
That failure to verify was costly for the investor, who lost his entire investment after the borrower defaulted. The FSRA's investigation found that neither Trivedi nor Somasekaram Pillai processed the transaction through their brokerages, which meant the investor was deprived of regulatory protections.
Exactly. And both agents admitted to splitting a broker fee outside their brokerages. FSRA cited multiple breaches, including Trivedi's intentional concealment of information and provision of false statements during the investigation. It's a stark example of how noncompliance can lead to severe consequences.
Somasekaram Pillai also admitted to acting as a middleman and collecting commissions without verifying the legitimacy of documents. The FSRA concluded that their conduct was reckless and that they shouldn't benefit economically from their contraventions.
This case highlights the FSRA's ongoing efforts to crack down on unlicensed activity and noncompliance within Ontario's mortgage sector. It underscores the risks associated with dealing outside a licensed brokerage and the importance of due diligence and transparency.
Absolutely, Steve. As private lending and syndicated mortgage investments continue to be scrutinized, it's crucial for agents to maintain transparency and adhere strictly to regulatory standards to protect investors and ensure the integrity of the market. Let's turn our attention to Bank of Canada Governor Tiff Macklem's recent comments on Canada's labor market. Despite a gain of 60,400 jobs in September, Macklem described the labor market as soft. Steve, what are your thoughts on this assessment?
It's an interesting perspective, Sandy. Macklem pointed out that while there was a job increase in September, it only partially reversed the loss of over 100,000 positions in the previous months. This suggests a level of volatility and uncertainty in the labor market.
Right. And Macklem also highlighted the rise in the unemployment rate to 7.1% from 6.6% earlier this year. He mentioned that job losses in heavily tariffed sectors are contributing to this softness. It's a complex situation for the Canadian economy.
Absolutely. The uncertainty firms are feeling is reflected in the soft hiring trends. Macklem's comments suggest that even with the recent job gains, the economic outlook remains cautious, especially with ongoing U.S. tariffs impacting exports and business investments.
Macklem indicated that the Bank of Canada is expecting soft growth in the second half of the year. He mentioned that while there was strong consumption in the second quarter, it's likely to ease. The expected growth is about 1%, which is below potential growth.
That's right, Sandy. Macklem emphasized that the growth, although present, is not robust enough to close the output gap. Immigration slowdown is another factor that's likely contributing to the lower potential growth, which Macklem noted might be below 2%.
With the Bank of Canada set to release a base projection in its upcoming monetary policy report, Macklem acknowledged the need for humility in forecasting amidst heightened uncertainty. He stressed the importance of considering risks in their assessments.
Exactly. The central bank is also keeping an eye on inflation, with headline inflation near the 2% target. However, some core measures remain elevated, which could complicate future rate decisions. Macklem's cautious stance reflects the delicate balance the bank is trying to maintain.
Macklem also touched on the importance of infrastructure investments, which he believes could lower business costs and stimulate private investment. This could be a key factor in supporting future economic growth.
Infrastructure development does have the potential to boost economic activity, Sandy. It's clear that the Bank of Canada is considering a wide range of factors as it navigates the current economic landscape. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.